Welcome to episode 3 of our educational series on passive real estate investing basics. Be sure to watch our series on 1031 exchanges and real estate taxation basics. We also encourage you to read our book, How to Retire from Being a Landlord, which you can order for free on our website or on Amazon.
Many of the folks we talk to are weighing their options between investing in a single-tenant, triple-net property or investing in apartments. In this episode, we'll break down the most important differences between these sectors. Just to make sure we're on the same page, a triple-net lease means the tenant essentially takes responsibility for the cost and operation of a property. And when we talk about apartments, we're referring to a newer market-rate community with at least 100 units.
Clearly, a single-tenant triple-net lease property concentrates all of your tenant risk into one company. Some tenants, like Amazon, have a very low credit risk, while a local mom-and-pop retailer could be out of business and halt payments at any time. Tenant risk is completely binary in a single-tenant property. Your occupancy is either 100% or 0%. On the other hand, a large apartment community may have hundreds of tenants, with an historic vacancy range that remains within a narrow band. Indeed, when you exclude a few years in the early 2000s, average rental housing vacancies in the U.S. have stayed between 5 and 9% for the last 60 years. Jason, tenant risk is obvious, but what about cap rates?
Yeah. In episode 1, we discussed how investors price properties largely based on cap rates. If a cap rate goes up over time, your property's net operating income must increase proportionately just to maintain its value. All things being equal, if rent payments from a triple net tenant only increase by 1% per year, the property may actually lose value, say 5 years later, if cap rates for that property type have crept up due to interest rate pressure or other factors.
With apartments, however, it is possible for rental revenue growth to outpace the modest rent bumps seen in triple net leases. This is because large properties have leases renewing on a weekly or even daily basis, creating opportunities to raise rents.
Of course, excess supply, bad management, or macroeconomic forces can impact the revenues of a property, and unforeseen expenses can hurt the bottom line. But while triple net lease revenue is contractually predetermined, apartment NOIs at least have a fighting chance of keeping up with a rising cap rate environment. The same can be said for sectors like self-storage, senior living, and student housing.
Finally, let's touch on operations. Undoubtedly, owning a triple net lease Burger King is a simple proposition, while owning part of a large Class A apartment building may be daunting. The complexity of operating a multifamily community is much greater than a restaurant or warehouse, and there is greater risk of an operational issue arising. Thankfully, for investors in passive replacement programs, a master tenant working with an institutional property manager stands between the owners and the apartments. Routine matters at an apartment community or self-storage facility do not become headaches for investors.
Bottom line, a single-tenant, triple-net property with a highly credit-rated tenant can be a reliable source of passive income, but with significant concentration risk. A passive multifamily property offers less mathematical certainty of income payments, but it has a greater potential for NOI growth, which after all is the primary factor in driving future appreciation.
In other words, an investment with lower initial cash flow may end up having a higher total return.
Thanks for watching. Be sure to watch our other education modules and visit our website at 1031capitalsolutions.com.